Hey everyone, welcome back to Corporate Dakota. Today, FBRT just filed its Q2 2026 earnings report, and I'm seeing some interesting shifts in their business that might surprise you. Quick note, this is not financial advice, just my take on public filings for educational purposes. They've got a much bigger operation now thanks to an acquisition, and that is changing how their money looks. Franklin BSP Realty Trust Incorporated, or FBRT as it's known on the stock market, is a real estate company that focuses on lending money for commercial properties. Think of them as a specialized bank for businesses that own buildings like apartments, offices, and warehouses. This report covers the second quarter of 2026, so we're looking at their financial health from April to June of that year. Let's dive into the numbers starting with their cash. As of the end of June 2026, FBRT had about $136 million in cash and equivalents. This is a bit lower than the roughly $167 million they had at the end of December 2025. It looks like their cash reserves have decreased a bit, likely due to their business activities. Now, their main business is lending money for commercial properties, and they had about $4.3 billion in these loans outstanding. It is important to note they set aside over $54 million as an allowance for potential losses on these loans. This is a significant increase from the roughly $38 million they had set aside at the end of 2025. Which could mean they're seeing more risk in their loan portfolio or being more cautious. When it comes to borrowing money, they had about $802 million outstanding on repurchase agreements and revolving credit facilities, mainly for their commercial mortgage loans. This is down from over $1 billion at the end of 2025, suggesting they might be managing their borrowing costs or have less need for this type of financing right now. A big chunk of their borrowing comes from something called Collateralized Loan Obligations or CLOs. These are basically pools of loans bundled together and sold to investors. FBRT had nearly $3 billion in these outstanding. It is a complex way to get funding, but it is a significant part of their financial structure. A major event impacting these financials happened on the 1st of July 2025, which was the acquisition of NewPoint Holdings JV Incorporated. This company, now called their Agency Business Unit, specializes in loans for apartment buildings and other multifamily properties, often working with government-sponsored enterprises like Fannie Mae and Freddie Mac. They bought NewPoint for a hefty sum, about $428 million. This deal significantly expanded their business into a new area and brought in new types of loans and servicing operations. As part of the NewPoint acquisition, they recorded goodwill of about $92 million. Goodwill typically represents the value of a business that can't be tied to specific assets like brand reputation or growth potential. It shows they paid a premium for NewPoint, expecting future benefits. After buying NewPoint, their mortgage servicing rights, or MSRs, became a significant asset valued at over $205 million. MSRs are basically the right to collect payments and perform services for loans they sell, and it looks like this business is a key part of their strategy now. The MSRs saw a good chunk of amortization though. Nearly $20 million in just 6 months, which is how the value of these rights is recognized over time. Looking at their profits for the second quarter of 2026, FBRT reported a net income of about $15.6 million. This is down from over $23 million in the same quarter of 2025. It seems the growth from NewPoint hasn't fully offset other challenges, possibly related to those higher loan loss provisions or rising interest expenses. On a per share basis, their basic earnings were 12 cents for the quarter, down from 19 cents in the prior year. This drop in earnings per share reflects the lower overall profit and a slightly lower number of outstanding shares. Their book value per share, which is basically the company's net worth divided by its shares, increased slightly to $14.51 from $14.38 at the end of 2025. This means the company's underlying asset value per share has grown, which is a positive sign. A big concern for any lender is non-performing loans, meaning loans where borrowers aren't making payments. FBRT had about $344 million in these loans. As of June 2026, this is a significant increase from around $214 million at the end of 2025. It indicates a growing problem with loan defaults in their portfolio. Their total operating expenses really jumped in the first half of 2026, reaching about $111 million, up from nearly $60 million in the first half of 2025. A large part of this increase comes from compensation and benefits, costing them over $43 million in the first 6 months of 2026. A direct result of bringing NewPoint's employees onto their payroll. FBRT also reports something called distributable earnings to common, which is a way to measure their performance excluding certain accounting adjustments. For the second quarter of 2026, this figure was about $23.4 million. On a per share basis, it was 25 cents. It is interesting to see how this compares to their GAAP earnings per S-share, which was only 12 cents. The difference highlights the impact of those accounting adjustments like unrealized gains and losses. Let's talk about how much debt they're using. Their total leverage ratio was 2.6 times at the end of June 2026. This means for every dollar of equity they have $2.6 in debt. This is a slight increase from 2.5 times at the end of 2025. While leverage can boost returns, it also increases risk, especially in changing market conditions. When it comes to interest rates, FBRT is pretty exposed. The filing shows that if interest rates went up by 0.5%, their net interest income would actually decrease by about 0.39%. This sensitivity to interest rates is something to keep an eye on, especially in the current economic climate. Looking at legal matters, FBRT is facing a securities class action lawsuit filed in early 2026. They believe the suit is without merit and plan to fight it. This kind of litigation can be costly and distract from business operations, though FBRT states it won't materially impact their financials. FBRT has a share repurchase program, and in the second quarter of 2026, they bought back about 1.8 million shares of their own stock for around $16 million. This usually signals that management believes the stock is undervalued. Finally, let's touch on their CLOs again. One of them, the 2024 FEL 11 issuer, has a reinvestment end date in late 2027. This means they can still add new loans to that pool until then, potentially impacting future returns and risks. So, what is my take on FBRT? The NewPoint acquisition clearly expanded their business significantly, especially into the agency lending space, which is good. However, the rise in non-performing loans and the impact of higher operating costs, particularly compensation, are definite concerns. The increase in their allowance for credit losses also suggests a more challenging environment for their loan portfolio. Their book value per S-share is growing, which is a positive signal about their underlying assets, but the increased leverage and sensitivity to interest rates add risk. The big question for me is how effectively they can manage these growing loan risks and integrate their new agency business while navigating market uncertainties. I'll be watching their loan performance very closely in the coming quarters. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this breakdown helpful, make sure to like and subscribe for more. See you next time.